financial statements. Basically, what it's about, Gugu, is that we've now set up an income statement and a balance sheet, so we've got all this financial information. And now comes in the clever people. And they go look at this information and they analyze it. Okay. Now, if you look at this block here, this block will tell you what is the things they're going to look at. And I'm going to test this. Okay, so know the words. So the first thing is your profitability. Is this business profitable? Ne? And we're going to work out percentages to calculate that. Because we want to see, is this business growing? Is the profit growing? Right? And they're going to analyze all the profits, the gross profit, the operating profit, the net profit. They're going to look at the markup. All of that they're going to look at and compare it to last year's figures and see if there's an improvement. So can you see that all of the ratios that we do with profitability will be ratios that will be influenced by the amounts on the income statement? Right. The other ones is mostly balance sheet. Right. So now, the next one they're going to look at is your return. So the return would be on your investment. So what are they doing with this one? What they are actually doing is they're saying, oh, you know what? The owner put in 100,000. Ne? The end of the year, the net profit was 50,000. So now they work out that net profit as a percentage on his investment, and they say, oh, if he got a return, he got back this percentage. Right. And then what investors do is they will go and compare it to other investments so that you can put your money where you get the best return. The most basic return that you know is on your savings account. It's interest. Fixed deposit, interest. That interest on the fixed deposit, in other words, if I say to you, the interest on fixed deposit is 8%. That 8% is the return on investment. You see? Meaning you're getting 8% extra back with that which you put in. So that's an important ratio. The other ratio is my solvency. So solvency means I'm going to do total assets as a ratio to total liabilities. We're not going to do the calculation. I just want to see in relationship to each other, do I have more assets than liabilities? And this is where that thing comes in. So let's say, remember when we did the bad debts and we said for that debtor, oh, the debtor was declared insolvent. Ne? His estate pays out 10 cents in the rand. You remember that statement? So that's solvency. Okay? So it means for every 1 rand liability, he only got 10 cents to pay for it. That's what that whole sentence means. And we will calculate that when we do ratios. I will teach that to you next year. Liquidity is about your cash. Liquidity is, do I have enough current assets to cover current liabilities? Meaning short-term debt. At this stage, do I have enough? If I sell all my current assets now, I turn all of them into money, will I have enough to pay all my short-term debts? And can you see, that's why I make a part of the long-term loan a short-term loan, because I want to see, do I have money to pay it? Okay. So, liquidity, so if I look at the definition, solvency is, can you pay off all debts. Liquidity is, can we pay off short-term debt? You see, that's the difference. So I am only going to do with you the profitability ratios. So the profitability ratios are extremely easy ratios because they give you the format. Look at this. If I say I put the scissors on the table, what's on top, the scissor or the table? The scissor. So now let's read here. Percentage gross profit on sales. So go look at the ratio. What's on top? What's at the bottom? And turnover is sales. Your turnover is your sales. Percentage gross profit on cost of sales. Can you see? Percentage net profit on sales. Can you see? Percentage operating expenses on sales. Percentage operating profit on sales. So when they ask you to calculate that, they actually tell you exactly how the ratio looks like. You see that? Okay. The only one that they can ask a bit different is this one. The percentage gross profit on sales. They can ask you to calculate the markup. Okay. Sure. So, when we do the exercises, you do not get marks for writing down the ratio. Okay, so let me show you. They asked me to do the percentage gross profit on sales. How will I do that? I will say gross profit on top, sales at the bottom, percentage means it's times 100. Now I go look on my income statement. What's my gross profit? 618. What's my sales? And if I don't say sales, I say turnover. It's exactly the same thing. Turnover is sales. Times 100, 50% on the dot. And I mark it like this. 1, 2, 3. Can you see no marks for gross profit on sales? I mark the amounts. Okay. You guys see that?
So would we like maybe while doing the thing, give us the what are the adjustments and the what and then you have to do this?
No, it will be a separate question. Otherwise, I have to go back to all your mistakes and do your calculations for everyone. Okay. Now, let's do the next one. Percentage gross profit on cost of sales. Let's say they said, calculate the markup. Then you have to know it's gross profit on cost of sales. So gross profit, cost of sales. Can you see why I said this is easy? And I want you to be able to do this because you're going to get 100% here. It's going to add your marks here. This is where you're going to lift your marks in paper 1. Okay. I don't know. If I ask all of this, it's 1, 2, 3, 4, 5. It is 15 marks. Okay. So let's see. Percentage net profit on sales. So now I take the net profit of 300,000. Did I miss one?
Is it not going to be muted?
No. It's just the lens is muted. That one is muted, not this one. Not this one. Okay. So the next one, I take the net profit and I put it on the sales. And I times it with 100 and it gives me Say again, baby. And this is literally how we do everyone. Operating expenses on sales. So I take the expense on the sales. So this one will actually tell me how much of my sales goes into covering expenses. So 27%, almost 28%, goes into covering expenses. So can you see this ratio? I want this percentage to go down. There's an improvement if it is next year 20%, because then it means a smaller piece of the sales goes to expenses. Okay, and the last one, operating profit on sales. So what makes operating profit a significant thing is this is all about my daily operations. This is the profit I make when I don't take my financing costs into consideration. In other words, if I don't take my investments and loans into consideration, this is my pure profit. You see? Okay? And that would be 20. And you always do 2 decimals. Okay?